Older happens to all of us. So let's talk about the elephant in the room, aging. Your journey is yours to shape, and I'm Allison O'Shea, founder of Openly Aging. We're ditching the fear and embracing aging with intention, confidence, and control. Thank you, everyone, for being here. I get a lot of questions about long term care insurance. And if you have a policy, how's the best way to use it? Or if you're interested in looking at policies for the future. So I thought a perfect guest for us to have on Openly Aging with Allison would be somebody that can educate us in long-term care insurance. So I do want to welcome Bill Comfort to Openly Aging with Allison. Bill, welcome. We're excited you're here.
Thanks, Allison. Glad to be here.
Yeah, and so I'm going to read a little bit about Bill's background so we understand why he's the professional that we all need to know. So Bill is a nationally recognized continuing education trainer in the field of long-term care planning and long-term care insurance. He's been in the industry since 1991 and exclusively has specialized in long-term care insurance for 25 years. He is well known with companies who file claims with long-term care insurance and how best to navigate that and use their systems to get paid, but also so that their customers can use the benefit of their long-term care. He created Long-Term Care Claims Professional. It's a training program, and he's had great success with that. Bill's view on long-term care planning and long-term care insurance and long-term care claim issues have been featured in Wall Street Journal, the Barron's, the Journal of Financial Planning, U.S. News and World Report, McKnight's Home Care, CBS Market Watch, Smart Money, Kiplinger's Retirement Report, Private Duty Insider, and numerous insurance industry publications. Woo! And he's been on Fox News series Road to Retirement. So, needless to say, we are very lucky to have Bill here. And
And
I've known
and
Bill
and
for many
now
years. Yeah.
and now on Openly Aging with Allison.
Yes, there you go. We're going to add it. And I've known Bill for many years, and he's just a wonderful person to work with. I always bounce ideas off of him or questions. And so, thank you, Bill, for being here today. So we're going to get started. Like I said at the beginning, I get a lot of questions on both ends of long-term care, people that already have and people that are thinking about getting. So we're going to split this conversation up into two sections, essentially. So we're first going to talk about people that already have long-term care policies and how best they can use them, when to use them, all that. So before we get into that, I do notice, and people will notice when they see the notes on here, you've got a lot of letters behind your name. Can you tell us a little bit about what those mean? I read a little bit about your background. Tell us how you got into this.
Yeah. So my first career, which was more than 34 years ago now, was in journalism. I have a journalism degree, did radio and TV broadcast news out in Kansas. I was a journalism professor for a couple of years, did documentary work. That was in my 20s. And I started having a family, was looking for other things to do. My dad was in the insurance business, so I kind of grew up around it. Wasn't afraid of it. Didn't think it was something I was going to do. But we got to talking, and it was a very natural transition for me. And that was back in 1991. And I started, like many agents do, being kind of a generalist, help writing life insurance and doing a little bit of investments, mostly with people around my same age. And I developed an early specialty. This was in the early to mid 1990s around disability insurance. It was something that my dad and the other partners in the practice that I was joining didn't have a lot of expertise in. So that kind of became my specialty. And long-term care insurance in the early to mid 90s was really coming into its own finally as a comprehensive product with new regulations around it. And if you think about it, it's really a type of disability insurance. I like to refer to it as post-retirement disability insurance. And instead of defining the disability as being unable to work during working years, long-term care is a disability in your functioning, where you need help safely getting through the day. But it's still a type of disability insurance. If you need help, if you need care, the policy makes money available to help pay for that care. So uh, as the 1990s went along, I just kept getting drawn back to this subject. And I realized I just wired better as a specialist than
Mhm.
a general practitioner in insurance and financial planning, if you like. So in 2000, I left the very general, broad-based insurance practice that I'd been part of and started an agency dedicated exclusively to long-term care insurance. And that's what I've been doing and specializing in, as you said, for 25 years.
Wonderful. All right. So, one of my first questions we get a lot is, so we already have a policy. How do we, when is the right time to activate it, if you will, use it, or, and do we need a doctor to kind of sign off on it? What does that look like when we first initiate this policy we've had for a long time?
Yeah, that's a really good question. It's one I hear a lot, both from clients or people who call me with the question, or other senior care professionals, home care agencies who have clients asking that same question. Um, if you need help, if someone you love, so a spouse, a parent, a partner, has is not safe getting through the day, whether there's developing physical limitations or perhaps developing what we call a cognitive impairment. We think of things like Alzheimer's, dementia, but it could be a stroke or even a head injury
Mhm.
that could lead to that as well. So I think a simple sort of answer to that is, if you're beginning to worry for yourself or someone else that you love about day-to-day ongoing safety of that person, just safety concerns, that's the time to start considering using the policy or activating a claim. We'll talk a little bit as we go along about how do you become eligible to do that. Um, but I think a lot of people wait until they're right in the middle of a crisis.
Mhm.
And then it's a little bit harder to navigate because there's so much emotion involved. So if there's kind of that nagging feeling, I wonder if we ought to use it. I wonder if it's time. That's a great place to start getting some advice. And
Mhm.
one of the things I've learned is the more you can have all your ducks in a row, all of the pieces of your story, your claim story, your care needs story, the more of that that's in place before you make that first 800 number call to the insurance company, the better off you're going to be. Now that requires working with, someone who specializes in it.
Yeah.
A lot of care managers, a lot of home care agencies, they have people that are knowledgeable and can help with it. So I think if you feel like you might need it to use it, that's probably the time to really dig in and understand what you have, how it works, and what's needed to start a claim. And let me say this, and we'll kind of work into some more details.
Mhm.
Don't be afraid to start a claim and discover or find out or have the insurance company determine that you're not yet eligible. That could be a little frustrating, but it just means you haven't reached the level in the policy for eligibility, but there's no penalty to doing that. Your rates don't go up just because you file a claim, whether it's accepted or denied,
Mhm.
or postponed or whatever. So don't be afraid to ask for questions or start the process, um,
Yeah, I mean, I
especially if you're
think
worried.
that's perfect advice because I know from my experience, 20 years in senior living, where we process claims or started claims, we didn't process them, we just initiated them, is every policy can be different
Oh
in
yeah.
what, how to initiate it, what the eligibility is. So I love that idea of like, there's no shame. If you're having a little bit of a feeling that, ooh, let me see if this could help us right now, go ahead and start.
Right.
But to your other point, it can be a little complicated, the
Yeah.
claim process. So speaking with somebody who has a little bit more experience, like you said, if you're starting to have home care come in, they should have somebody in their, office that can help, a care manager. So reaching out for that kind of support if you're thinking it's time, but there's no, you know, filing that claim, do it if you feel like you need to. So
And,
that,
and and you mentioned, what about somebody's doctor? Can can
mm,
can their doctor help them, do this? And the short answer is yes. And doctors, though, it's interesting. Doctors provide, skilled, responsive medical care to illnesses and injuries. They're not really, they're fix-it people, not, custodial care, managing safety in the home. And it's just a different discipline. So
yeah.
sometimes physicians aren't really are not deeply knowledgeable of what kind of care is needed or how it works at home. Now, I will say this, if there's if there's safety concerns, again, whether it's because of physical limitations or mental cognitive limitations, one of the critical things to do before you start a claim, if you can, is make sure your primary care physician has some notes about that.
Mm,
Just, there might not be a specific diagnosis, but if there have been some falls
mm.
or fear of falls, maybe there's been a couple of falls, but no injury, no emergency room visit, no doctor visit, but that it could be very different the next time. So I tell people, go have an appointment or at your next appointment with your physician, particularly if you're feeling some of these kind of frailties, generally
Yeah.
coming on, and tell your doctor, I'd like you to make sure you note in my records that I have concerns about my safety doing these activities in the house. By the way, I've had a couple falls. Thankfully, I haven't gotten hurt. But and the reason you want it there is the insurance companies, they always write for records, both from your care providers, but also particularly from your primary care physician. And they put a lot of weight on what's in the doctor's records. And sometimes you have to tell the doctor what to put in the records. Um, if it's an adult child who's worried about a parent, go to the next doctor's appointment with them or
Mhm.
set an appointment for a checkup and make sure some of these concerns get into the record as a bit of a narrative. That's probably the best thing to do from a starting point.
And great point, because one of the things I work on in openly aging is helping people be, acknowledging that they're aging. So for some people, the fear of having a doctor write that they're falling, they feel like someone's going to drag them off to the home. But
Right.
you're doing it in a strategic way that it doesn't mean you're less independent. You're just kind of planting the seeds. So God forbid something does happen and you do need some more support. Because that kind of goes to my next question. There are some, you can't just like call your long-term care insurance and all of a sudden they're going to be paying you. You have to prove
Right.
that you need some sort of support. So can we talk through that a little bit and what that may look like?
Yeah. So and that's where everything starts.
Mhm.
So what I say is nothing happens with your policy until you are benefit eligible.
Mhm.
And it's really a definition of disability, again, to use that analogy. Some people call it the benefit triggers. What are the
Yep.
conditions or the care needs that trigger the start of coverage or the eligibility for your policy to start? And again, kind of a goofy analogy, but it's like having a fine mechanical Swiss watch that's going to keep impeccable time, but it doesn't do anything till you wind it.
Mm.
So the way you wind long-term care insurance to start is you have to be benefit eligible. That has to be shown to the insurance company. The
Mhm.
insurance company has to, review records, maybe do an in-person visit with you, what they call a face-to-face assessment, as part of that eligibility process. And the good news is, for 25 plus years now, that measure, the standard of eligibility, is very uniform or standardized with most coverage. Policies issued before 2000, in the 1990s, let's say, there could be some variations on this, which is why it's important to know what you have
Mhm.
before you even get started. But let's talk about what the criteria are. And it's one of two, and these are separate measures. So it's an either or. Either you need supervision because, again, for what the policies call a cognitive impairment, a mental
Mhm.
limitation,
Mhm.
memory, reasoning, judgment, especially as it relates to your safety. So if you have Alzheimer's, early stage dementia, a stroke that's affected the computer more than the
Mhm.
machinery, for example, um, if you need someone around for your safety, your health on a regular basis, that's one level of eligibility. Now, you don't have to be, um, it doesn't have to be at a level where you need to be have professional care 24/7 or even in a facility.
Mm.
Could be that you have caregivers come in 6 hours, 4 hours a day, so your spouse can go shopping or get a break or do something else, for example. But then your spouse is with you the rest of the time.
Mhm.
But if you really shouldn't be left alone, again, because of cognitive issues, that's one track.
Okay.
The other track is, and I've referred to this, is you need physical help. And that's what we refer to or measure by the activities of daily living,
Mhm.
or ADLs. And long-term care insurance uses six. And it's really important as you're considering starting a claim, knowing what those six ADLs are. If there's concern with a couple, the doctor needs to register it. Home care companies, rehab facilities, they sometimes have a list of 10 or 12 ADLs, but to qualify for long-term care insurance, the companies only look at six. And you don't have to remember all of them, but let me kind of tell a story. And I think this is a way to understand them, if not remember them. The basic activities, and what the policies say is, if you need help with at least two out of this six.
Okay.
So think about what we do normally, naturally, all of us, every day after we first wake up in the morning. We get up out of bed. That's transferring, which means getting in and out of bed or a chair. We go into the bathroom and use the toilet. So getting to and from, on and off, and managing our hygiene independently. So transferring, toileting, and then to just sort of play the story out, we bathe or shower.
Mhm.
Bathing is one of the ADLs. We get dressed. That's an ADL. We go down to the kitchen and we eat breakfast. And then the last one is continence. Throughout the day, can we maintain and manage our continence? Or if not, are we able to do that safely and effectively? So, for example, the two most common ADLs that are lost first are bathing and dressing.
Mhm.
Balance is involved, fine motor, gross motor skills. There's a lot of slippery, hard surfaces in both places. So if you need help with any two of those activities, you're eligible. Now, let me put a little finer point on this, and this is what's often missed. You do not have to be flat on your back, unable to do anything. The need for help in most policies, uh, 9 out of 10, if not more, the need for help to be eligible to start your long-term care insurance only has to be standby help,
Mm.
right? So if somebody has to physically help lift you up out of your bed, that's what we call hands-on assistance, and that would certainly qualify. If somebody has to physically hold on to you while you step in and out of the shower or tub, that's hands-on assistance. But because of safety, balance, frailty, fall risk, you need somebody standing by just in case. That's enough to start a claim. So
Mm.
back to your lead-in question, Allison, when should we start?
Yeah.
Long-term care insurance can start a lot sooner, providing benefits than most people think. Supervision for cognitive related to your safety and health, or at least standby help so that you safely can complete these activities physically, getting through the day.
Great. And I am sure some people listening today will also, I don't know if my heater will go. I'm sure some people listening today maybe are doing some of these tasks for a loved one or having some of these tasks and didn't realize that they could be tapping into their long-term care, policy. They think it's not as bad yet. And that kind of leads me to my next question I sometimes hear is, as an expert in this, if I have long-term care insurance, should I hold on to it and wait to see if my care costs go up? Or does it make sense to tap into it as soon as I need support? I think it's a good question because you're risking never being able to use it if you wait, because gosh forbid
Right.
something happens. But at the same time, are you for the benefits that have a time frame on them, can we talk a little bit about when you recommend somebody who has a policy tap into it?
Yeah, that's a great question, and it's a really common question, and I get it. So most policies have a benefit period limitation, which really creates a limited pot of money
Hmm.
that you can use, and which is however much the policy pays per day or per month times the number of years. So the money doesn't run out after a period of time, it runs out after you've used up the pot of money. In other words,
Okay.
that 3 year or 4 year benefit period's just kind of a multiplier. It's easy to think about it in terms of time, but um, so it's really natural to think, well, we're just getting a little bit of care now. We can afford, the limited home care services that we're getting. So we'll save our insurance money for later.
Hmm.
Like you
Exactly.
said, either, care could go on for a long time, or what
Mhm.
if costs go higher? I understand the sentiment, but from a financial planning, financial management standpoint, it doesn't make sense to save the insurance money. Save your own money for
Hmm.
later. And you suggested this, Allison.
Hmm.
If somebody has a 4 year policy, for example, and they pay just out of their own pocket, even at a lower level, for the first year of needing care, of paying, let's say, home care aides, and then after the year they start to use the policy, and then they only use the policy for 2 years before they die,
Hmm.
they lost the
Hmm.
opportunity to get the money because the insurance company doesn't pay you out what you didn't use. You didn't use it. Um, so it just from a financial standpoint, it's generally better to start it sooner versus saving it for later.
Got it.
And let me give an example related to this kind of pool of money idea. And let's say somebody has a policy that by the time they're going on claim today, maybe pays $200 a day, 6,000 a month. And they're only spending 3,000 a month, 100 a day on home care. 3 or 4 hours a day, few days a week maybe. If you have a 4 year policy that would pay 6,000 a month, but you're only drawing 3,000 a month, the policy doesn't end after 4 years. The benefits you don't use each
Okay.
day or each month stays in the policy and basically stretches it out longer. So it's not a time limit again, but the $3,000, you'd be better off using the insurance company's 3,000 today and keeping your own 3,000 in the bank and save that for later. It's the same money
That's
at the
great.
end
So
of
it's
the
an
day.
either or. It's 6,000 in 4 years or,
3,000
yeah.
for 8 years.
Right.
Yeah.
Okay. That's very, thank you. That's
Now,
helpful for me.
you can't take it faster. So if
Okay.
you have 200 a day or 6,000 a month, you can't get more. But
Right.
if you don't use all of it along the way, you can stretch it out longer um, that
Great.
way. Now, a couple other things. You should file a claim sooner, determine your eligibility. I mean,
Hmm.
that's
Hmm.
a fairly involved, detailed process. Medical records, got to wait for the doctors to send those in. They got to send a nurse assessor out from the insurance company to confirm that you're eligible. There's a lot that goes into that. So why not get that out of the way?
Mm.
And most policies have what's called an elimination period, which is the deductible. And the most common is probably 90 days, could be 30 days, could be 6 months, but 90 days is the most common. And that's where you have to be both eligible and paying for care yourself to it, satisfy the deductible. It's a time deductible, not just a dollar deductible. But why not get that out of the way now
Right.
and then decide how much you might choose to collect from the insurance company or not? So there's a lot of reasons, I think, to start sooner rather than saving your benefits for later.
And if somebody has questions about their own policy, do you recommend them going back to the person they got the policy from, or are there other specialists that could help if somebody's like, I don't know how to read this, I would like more information on my specific policy? Who do you
Yeah.
recommend people go to?
Yeah, that's a great question. And let me start with this. You have to have a copy of the actual policy,
Okay.
the contract, the 40 or 50-page detailed contract. If all you have is a file full of billing statements or the original quote the agent gave you 20 years ago or some or brochure, that is not enough to fully analyze your coverage.
Okay.
So if you're working for an adult parent and you can't find it, or the individual just doesn't have it anymore, the insurance companies have to give you a copy. Call the insurance company, find out how to do it. Some companies, it takes 4 to 6 weeks for them to mail you a new
Yeah.
copy. More and more companies have online portals,
Okay.
and once they kind of prove identity and that kind of thing, some of them, I'm working on a case right now where the company said it'll take 10 days to 2 weeks to mail the policy. And then the family got on the portal, requested it, and digitally, it was available in 3 days for them to
Hmm.
download. But you have to have that.
Hmm.
If somebody calls me and says, can you help us understand what we have? Whether I do that with people anticipating a claim or just they're healthy and 72 and they bought the policy 20 years ago. And what do we have? How does it work?
Hmm.
Um, I want to see the actual policy.
Got
And
it.
I think any good advisor that would be doing this needs to help you look at the entire policy because those definitions are critical. Um,
100%.
so you got to get a copy of the policy. If the agent who sold it to you is still in the business, which isn't common, obviously go back to your own agent. Um, Maybe you have a new agent or a new financial planner or financial advisor. You might start with them.
Mhm.
Again, a lot of if you're hiring home care services, more and more of those offices have somebody who's knowledgeable and can help you. And then there's kind of a new growing profession of folks that get paid a fee to
Mm.
help people navigate the claims process.
Okay.
Could be an option.
Now, speaking of that, like reviewing our claims, I would love to hear from you some real life stories of maybe somebody has a long-term care policy and they were surprised at what it didn't cover that they kind of expected, or what it did cover that they also didn't expect. So, give me a little bit
Yeah,
of information on that.
yeah. So kind of to touch on something we've already talked about, a lot of people are surprised at how soon the coverage can start. Again, and I say this just in contrast, you don't have to be flat on your back, unable to do
Mhm.
anything. So standby assistance, somebody around just in case, balance, fall risk, frailty, for example, or supervision for your safety because of cognitive memory, judgment, awareness issues. And I think a lot of people are surprised about that the benefits can start sooner in that regard. I think probably the biggest surprise or disappointment that people have in what a policy doesn't cover is if they bought a policy but didn't add home care benefits.
Mm.
And generally, there could be some exceptions since 2000, the year 2000. Most policies written since the year 2000 are what we call comprehensive.
They have everything.
They cover the whole continuum: home care, adult day services, assisted living, memory care, and if you ever need it, a regular nursing home. So that's what we would call a comprehensive policy. And so if it was issued in the last 10, 15, 20 years, maybe, it's probably going to cover everything. It was issued before 2000, you got to look really closely because most policies back then, the basic policy was nursing home only or maybe facility only. So nursing home plus assisted living.
Mm.
But to get home care, you had to check a box on the application. You had to choose the home care rider, which had an extra premium to it. And I've seen individuals, I've seen more commonly adult kids who are upset that mom can't get a home care agency paid for by the insurance. Well, mom didn't choose to add the home care benefit. How do we know? We got to look at the policy to see what's in it.
And again, why it's so important if you have a policy to make sure you understand it today before you need to even activate it, and
Right,
understanding what it covers.
right.
So great. The other thing I hear quite often, especially from my older clients who have been paying their premiums, and obviously premiums can increase, do increase year over year, is when you're living on a fixed income, is it smart to continue to pay the premiums if you're 95 and still living at home?
Right, right,
85 and still living at home and doing okay. So, and I always encourage people, you've done it this long, I wouldn't make any changes, but I'm no expert. So I always send them back to an expert. But what is your take on, when these people receive the increase each year and kind of have panic, like, oh my gosh,
right, right,
So,
right. Yeah, it's a big deal because some of these increases uh, not only have been a fairly large amount, large percentage, but they're often successive increases,
mhm.
increase on top. There was an increase 10 years ago and 5 years ago, and they just got to notice that there's another one today. I have some clients who bought their policies, particularly, 15 to 25 years ago, and they've had their prices double, if not triple.
Mhm.
Now, that's a lot, but And it's emotional. It's not what we expected, although the premiums contractually were never guaranteed, and
Mhm.
nobody's being singled out. The insurance companies have to do it for everybody in the state, and it's regulated by the insurance departments.
Mm.
And the insurance departments have to make sure that the insurance companies are collecting enough premiums to pay claims. And
Mhm.
and again, we don't need to get into all the whys that this happened. But an interesting thing, to your point, I always ask, let's put the emotion aside. I know it's a big increase or another increase. Can you still afford it?
Mhm.
And a lot of my clients say, yes, but it's getting very expensive. I met with a client recently. Their premium was going up for the couple. Their premium was going up to 10,000 a year. But their benefit
Mhm.
with the inflation increases, their benefit had grown to over 10,000 a month
Mm.
each. So, the question is this still a good value
Mhm.
that's there? And I have clients as well who say, I can't afford these increases anymore. And what we try to do is strategically reduce the benefits, maybe shorten the benefit period some. There's some policies 20, 25 years ago that had unlimited benefits or 8 or 12 years of benefits. And, that's better than a shorter period, but it's better to keep the coverage
Yeah.
in
So
place.
you can adjust a policy.
You can adjust it down.
Okay.
So you can always shorten the benefit period or reduce your monthly amount, for example.
Okay.
You can't increase your coverage later. Um, and the other thing that's interesting, and I've done this analysis hundreds of times, but just kind of make up an example. Let's say I have a 75-year-old couple that's getting a big rate increase, and they bought their policy 20 years ago when they were 55. And let's say when they were 55, they bought 4,000 a month of benefits to start, and they bought the provision that automatically increases their coverage each year for inflation.
Mm.
So now at 75, they have, let's just say 8,000 a month of coverage. If I were sitting down today, 2025, with a 55-year-old couple buying the same starting benefit, so 4,000 a month, however many years with the inflation, that 55-year-old couple would be paying about the same starting premium as the rate increased premium that's hitting the 75-year-old.
Mm.
So let me simplify that message. The insurance companies aren't raising these rates to drive people away or make the business go away or get people to drop the coverage. They truly need it to pay the claims, and they're basically just bringing premiums up to what new people coming in at those original younger ages are
Right.
having to pay.
And I think
Doesn't
that's
take the sting out of
really,
it, but yeah,
yeah, and I think that's really the point that people don't understand is, or they probably know about it, but don't understand how this all relates is the cost of healthcare and the cost of care just keeps increasing. In
yeah,
senior living, when I started, a one bedroom in an assisted living was 4,000. And I was selling a one bedroom for almost eight by the time, I left.
yeah,
So that's what the insurance company is having to keep up with is making sure they can pay the cost of
right.
actual care. So I think that is important to note as we see these premiums go up is it's not just willy-nilly, it is because the cost of care is increasing and we can't
And,
deny
and,
that.
and you mentioned, what if the person's 85, 90 years old? What should they do? Well, they're that much closer to potentially needing to
True.
use this
True.
policy.
But I didn't
Um,
know, and this is something for me who know that you could decrease.
yeah,
If you're 95 and you haven't needed any care, okay, and you have an 8-year policy, does it make sense to decrease because the likelihood of you needing 8 years is so that's a great, I love that little tidbit I learned today. I've learned a lot, but that was a big one that I can now share if somebody does have that concern.
yep.
Um, So
And
switching
by the way,
gears. Oh, go ahead.
no, just a quick thing on that. Whenever anybody gets a rate increase letter from an insurance company, they always give you two or three options
Mm.
of how to
Okay.
reduce your benefits to reduce the premium sum. It's really important that people understand there are more options. Those are not the only options. You
Mm.
can you can choose something in between, something a little more. You can use a combination of things as well. So again, if there's a need to reduce coverage,
Hmm.
don't just necessarily accept one of the two or three options the company gives you. There might be something better,
So reaching out
individually.
to a professional would
Yep.
be very
Yep.
good. So before we switch gears to, maybe somebody who may be thinking about in our last few minutes getting insurance, what is your recommendation of somebody if they're at a certain age? What is too old for them? In your professional opinion, they should not even look at long-term care insurance. You know, what do you view that age to be?
Yeah, and it has more to do with health than age, but really after age, you can buy long-term care insurance, true long-term care insurance in any of its forms up to about age 79,
Oh, okay.
but you have to be in good health. Because the insurance company, you're paying a premium for an even larger benefit, and the insurance company wants to look at your medical history.
Mm-hmm.
If you have too many medical conditions that have built up, or maybe conditions that could potentially be progressive and cause a need for care, you're not going to get the coverage. And by the way, that's true whether you're 50 or
Mm-hmm.
70. Um, After age 70, it gets very expensive. But I have clients who have bought a little something to take the pressure off in their early 70s, but they've been in very good health.
Mm-hmm.
There's a couple of annuity-based plans that don't that as long as you're not getting care today or about to, as long as you don't have the ADL deficits or cognitive or whatever, that they're almost a guaranteed issue, but it takes your own money, a chunk of money. It's kind of a one-time exchange. For example, you give an insurance company $100,000 of your cash, and you buy an annuity. And it's a regular annuity. It earns some interest. If you die, your beneficiary gets the cash value. But these long-term care annuities will add another maybe 50 or 100% more for long-term care.
Mm.
So you turn 100,000 into 200,000 with very minimal health underwriting. And I've seen that be a much better option for many people in their 70s who want just a little bit of extra peace of mind. And if you think about it, if you use that annuity for your care, the first money comes back your own money anyway.
Right, right.
Typically the first 2 or 3 years, in my example, it's your own 100,000 coming back, and then after that, you get into this extra insurance money. And more people in their 70s have a nest egg
Mhm.
that they can, redeploy in this way, as opposed to somebody in their 50s or early 60s who is maybe still saving, right? They
Mhm.
don't, they don't, they don't want to transfer assets or have the assets to transfer. Ideally, 50 to 65 is kind of the range when most people buy. You can buy it
Okay, that was
younger.
going to be my next question.
Yeah,
When should we go see you? And when's it too
I,
early?
I don't think it's ever too early
Okay.
as long as you have other planning in place. So I've met with 30, 40-year-olds very interested in the subject. Maybe they had a parent or a grandparent who needed care, but they got kids. They don't have enough life insurance. They don't have
Mm.
enough disability insurance.
Mm.
And they probably need to do those things first. So sometimes there's a life stage to this.
Mm.
I'm working with a young doctor in his 30s right now who kind of has everything else in place, and he's worried about this. And he's like, I want to start now. And it's cheaper.
Mm.
It's cheaper starting early than waiting till later, and you're in good health. So, but at age 50, you really need to be seriously looking at this, ideally at 50 to 55. If you're 62, now's the time.
Okay. Everyone hear that?
Right, right.
If you're interested. Now, I keep having questions that pop up. So
That's all
now
right.
what if you never use the policy? Is it kind of like you lost it? I mean, but that it's almost an insurance policy, so you just have to understand that there is a potential that you may never need it. And is that how it works, or is there a beneficiary kind of component to
Yeah.
it?
So there's different designs, different
Okay.
options. What's called a traditional or standalone policy, that's what you and I have known
Hmm.
for the most part the last, 20 plus years. And and it's very simple. It's pure long-term care insurance. You pay a premium each year to be covered each year up to the limits you chose when you bought the policy. And if you never need care, you don't get anything back.
Okay.
That's insurance. Now, my sort of snarky analogy is none of us lay awake in bed at night wishing for a big house fire because
True.
State Farm's been ripping us off for 20 years, right? I mean, so there are some newer types of policies which are called hybrid or combo or linked benefit. There's a lot of sort of generic terms that are used. And that annuity that I mentioned is a type of a hybrid. It takes a regular annuity and adds some additional long-term care benefits to it. If you never need care, your beneficiaries get your cash value, like any other annuity. There are also now life insurance policies that have a long-term care benefit. So you can draw down your death benefit during life if you want to use it for care. And in some cases, maybe you draw down the death benefit over 2 years, and then the policy pays another 4 years after that for care. So
Mhm.
that's this hybrid or linking of life plus long-term care insurance. Um,
So
the
again, it's worth
advantage,
talking to a professional because there's a lot of options out there for
yep.
protection.
And obviously with the hybrid policies, if you never need care, there's a death benefit. But they're more expensive for the same dollar of long-term care coverage. The hybrid policies are more expensive because you're also paying for that death benefit as an
Mm.
alternative, which
Hmm.
is really a return of premium kind of
Right.
provision.
Right.
Um, and yeah, you got to talk to somebody who knows the difference. And here's where to be careful. A lot of agents and financial planners today are only selling these hybrids. And the traditional, yeah, premiums have gone up over the years, but they're also more rate stable looking
Mhm.
forward now because we've already priced in for the past mistakes.
Mm.
Um, and it's less expensive. So you can't just take a shorthand, oh, traditional long-term care is bad because it's use it or lose it. Well, yeah, what if it's half the price?
Right.
You keep your money in your pocket that you didn't spend.
Mm.
Um, so it's my one of my little sayings that guides me and my interaction with clients is the policy's not the plan. The long-term care policy helps you pay for your plan.
Mm.
And it's very unique. So if somebody says, what's best? Hybrid long-term care or traditional? I say it depends on the client
Hmm.
and their family, their finances, what they want. If somebody wants money back when they die, if they never need care, we can do that.
Hmm.
There's a cost to it,
Right.
but it's available.
Yeah.
And I think the reminder here, that's not the only option anymore. These traditional policies are still available in the market for
Got it.
people where that might suit them best.
Got it. Okay. Touching on that is, one of the things I always say is aging is universal, but your situation is 100% unique to you. And so
Right.
you're right. You can't take a one-stop shop or just because you're friends or, are going one route, it doesn't mean. So once again,
Right.
talking to a professional. Last big question before we start wrapping up, because I hear this often, especially from, my age group who, I'm not quite in my 50s. Um, why would we look at a long-term care policy and not just save or invest that money to have it later? What are the benefits of doing a long-term care policy?
Well, first of all, you can never out invest the benefit.
Okay.
If you need care, even after paying premiums for 30 years, you're going to get all your premiums back in a year. Maybe for a couple, one of them goes on claims. They're going to get all their premiums back in a year and a half or less, depending on, particularly if they started younger at, better rates and things like
Mhm.
that. So the idea that I can invest my own money and have more money later, that's only true if you never need care.
Mm.
And that might sound a little bit uh, kind of insurance guy, cynical of that view, but it's true. And I do this analysis with clients all the time. Let's look at it. Here's the other reality, Allison. It's not self-fund or long-term care insurance. It's almost always a combination.
Mm.
Most of my sales today, so if cost of care today, you know, 40 hours a week, which is part-time home care,
Hmm.
right? 40 hours a week, anywhere close to 24/7. 40 hours a week of home care, 6,000 a month. Good assisted living or memory care is 8 to 10,000 a month.
Hmm.
Most people are buying a policy today with a benefit starting at 4 to 6,000 a month. And the idea is let's take the pressure off.
Mm.
Let's insure part of this risk and co-insure, the other part of it. And again, this gets very sort of personal in a way. But here's the other thing. The insurance, how are others going to view it? How will your spouse view the money going out the door month after month after month if you don't have insurance? How will your kids view it?
Mm.
And that's a very subjective, very just kind of emotional reaction. But when you're in the middle of a caregiving crisis and you're worried about the money, even if maybe you don't need to worry about the money, you still worry about the money.
Oh yeah.
So again, one of these other little kind of
I
trite
love that
sayings.
idea of pause. My light
Yeah.
just fell. I'll
Oh,
edit it out. Um, I love that idea of you're not getting long-term care insurance to afford all the long-term health you may need. It's almost like to take the pressure off, turn down the
right,
pressure valve. Because what I see quite often too is spouses. If somebody needs support and the other spouse is nervous if they can stay home. And so
right.
you're absolutely correct. I love that way of thinking about it because that is exactly what you and I see as professionals all the time is people put into situations where they're having to make big decisions because of cost. And if they can just take even a little bit of that cost off, in something that they've invested in and have, paid into, that's a
And the
great way to look
biggest
at it.
the biggest problem financially is for couples when one needs care and they're both still alive.
100%.
Because in those circumstances, the cost of care is extra. It's over and above the ongoing monthly expenses, lifestyle costs for both of them. And you can't dip into savings because those savings have to stay in place for the future financial security of the spouse who's going to continue to live.
100%.
So we actually have policy designs that let us link a husband and wife or any couple, link their benefits together so they can use all the money for the first one if they need to.
Mm.
So just in a contrasting point, it's easier financially to self-fund a single person because if they move to assisted living, because it's hard for a single person to stay home.
Mhm.
right?
Hmm.
24/7 home care is more expensive than a nursing home.
Hmm.
So you move to assisted living. Well, all of your income can go to pay for your care because you're just taking care of yourself.
Hmm.
But when you have a couple with them both still alive, so what are the circumstances? What's the, I always start with, what's your plan for care? What would you want it to look like? And we look at different scenarios,
Hmm.
just like planning for retirement. What if we live to 80? What if we live to 90? What if we have this kind of lifestyle versus that kind of lifestyle? Do we have enough money? Right? That's the investment and retirement planning conversation. And long-term care planning really should take a similar approach.
100%. What if one of you gets sick and the other stay home? Would you
Right.
both be willing to downsize? No, I want to stay. There's a lot. I do that all the time with clients. It's a big, just putting the hypotheticals out there, and it makes people realize, oh,
Right.
we have to make some decisions. So, well, this has been so helpful. I have learned so much myself. But one last question is, an agent like yourself, are you certified in specific states? What does that look like if somebody is looking to reach out to you or somebody else that they know in this arena to ask questions or just to have somebody review a policy? Talk to me about your credentials and what that looks like for our
Right.
audience.
Yeah, great question. So to work with anyone who sells insurance is an agent. So whether they call themselves a financial planner, even if they're managing investments, if they're selling an insurance policy, they have to be a licensed agent and they have to be licensed in the state where the buyer of the insurance lives.
Okay.
So now that's not hard to do. Um, States are reciprocal, so everybody has a home state. For example, my home state is North Carolina. So my primary license is from the state of North Carolina, and that's the state that I'm directly responsible to for my continuing education and so on. But I'm licensed in about 25 or 26 other states. And it's very easy to get a reciprocal license in another state. There's just some paperwork and a
Hmm.
fee,
Hmm.
basically. So you don't have to work with an agent that's in your state. I Most of my work I do remotely, um, even across, even from Durham to Raleigh.
Yeah.
So many of my meetings are via Zoom
No, it's
these
the
days.
way.
Um, but I'm working with a client right now in Washington State, for example. And but yeah, they do have to be licensed. And again, you want to know, do you sell all the kinds? Are you able to sell all the different types of long-term care insurance? Or do you only focus on one type or another?
That's important.
I think that's the bigger concern.
Yeah. So tell us how people listening can reach out to you to find out if they're in one of those 25 states, but it's also to get connected with you if they have questions. Thank you so much for
Yeah.
giving us your expertise. So tell us how the
Yeah,
audience can
and
get in
and
touch.
thank you for the time and the opportunity to join you and start this along with you. This has been fun for me as well. My last name is Comfort, just like it sounds, and people laugh. They're like, "Really? That's your name for your business? You had to change it?" Nope, it just happened to work out that way. So the best way to get a hold of me, and I think the simplest thing to leave with people, my website is very simple. It's my last name. It's comfortltc.com. There's a contact form. You can drop me a note. We can schedule an appointment from there. There's a lot of educational information. There's a page just on claims that goes into a lot of detail about those eligibility things we talked about. So people can go and read some more information there as well on that side of the
Wonderful.
equation.
And I will put all that information in the notes. And I think it is important to understand why I chose Bill to talk today is because he really has used this platform of his company and what he does for education. I feel like that's one of where a lot of agents are, they there to sell insurance and that's great and that's their MO, but I love your approach to long-term care insurance and wanting to educate and wanting to have people just be educated consumers, which is one of the cornerstones of openly aging. And so I appreciate this collaboration. Anything you want to end on?
This has been a great conversation. I mean, there's multiple levels to this to
Oh,
go
yeah.
into, but that's really addressed on that individual consultative basis, whether it's claim time or planning ahead for care and buying long-term care insurance. So, thanks for the opportunity to talk to your audience and catch up with you as
Oh.
well, Allison.
Yes, wonderful. So, two things I took away, everybody, is it's never too early to maybe start a claim if you're just not sure if it's eligible. And everybody's situation is very unique. So, making sure you talk to somebody that understands your unique situation to offer you the best type of insurance, whatever that may look like. And I think the other one too is don't look at it as 100% to pay for care. It should really, if you're strategic about it, it should really be used to kind of help supplement, to help you get through, if you need any kind of support. So I learned a lot and thank you so much. And thank
You're
you
welcome.
everybody for watching. And I'll see you all next time on Openly Aging with Allison.